Good morning, everyone. I'm excited to welcome you to today's presentation on corporate accounting. Today, we'll be exploring some fundamental concepts related to share capital, including what it is, how it works, and why it matters for businesses. We'll cover topics like authorized capital, issued capital, and equity share capital, giving you a clear understanding of these key terms. So, let's get started and dive into the world of corporate finance. Now, let's delve into some of the common ways companies manage their equity and raise funds. First up is preference share capital. Preference shares are a type of shares issued by a company that come with fixed dividends and certain preferential rights, such as priority over common shareholders when it comes to dividends and repayment in case of liquidation. Essentially, when a company issues preference shares, it's raising funds from investors who prefer a steady income and less risk compared to ordinary shares. Next, let's talk about bonus shares. Bonus shares are additional shares that a company distributes to its existing shareholders, and the key point here is that shareholders receive these shares free of cost. Companies often issue bonus shares as a way to reward shareholders and to increase their holdings without asking them to invest more money. It's like giving a thank you gift, which also helps to improve the company's share liquidity and marketability. Finally, there's the concept of buyback shares, or stock repurchase. This is when a company decides to buy back its own shares from the open market or directly from shareholders. The reason for doing this can vary. Perhaps the company believes its shares are undervalued, or it wants to improve financial ratios, or simply to return surplus cash to shareholders. Buybacks can be a strategic move to enhance shareholder value and often signal confidence from the company's management in its future prospects. Connecting all these ideas back to our overall theme, each of these methods, preference share capital, bonus shares, and buybacks, are tools companies use to manage their capital structure, reward shareholders, and signal financial health. They play a vital role in how a business raises and allocates funds, ultimately impacting its growth and stability. Now, let's move on to slide 3, where we'll explore some important financial concepts. First, what exactly are debenture shares? Well, a debenture is a type of debt instrument, which is essentially a loan that a company or government issues to raise funds. Unlike shares, which give you ownership in a company, debentures represent borrowed capital that the issuer promises to repay with interest. They are a way for organizations to secure long-term financing without giving up ownership. Next, let's talk about goodwill. Goodwill is an intangible asset, meaning it's not physical like machinery or buildings. It reflects the extra value a company has over and above its identifiable net assets when one company acquires another. Think of it as the company's reputation, customer loyalty, or brand strength, things that add value but aren't tangible assets. Now, how do we go about valuing goodwill? There are several methods, including the average profit method, the super profit method, the capitalization method, and the annuity method. Each has its own way of estimating the worth of goodwill based on different financial factors. Focusing on the average profit method, this approach calculates goodwill based on the average profits of the business over a specific period. It's one of the most straightforward and commonly used methods because it relies on actual profit data, giving us a fair estimate of the business's earning capacity. Then there's the super profit method. This method considers the difference between the actual profits of the business and the normal expected profits, which are based on the capital employed. Essentially, it measures the extra profit generated due to factors like reputation or customer loyalty, what we call super profits. Connecting these ideas to our overall theme, understanding these concepts helps us better evaluate a company's value, whether we're looking at debt instruments like debentures or intangible assets like goodwill. Both are crucial in assessing the financial health and potential of a business. Now, let's move on to understanding what exactly is meant by the valuation of shares. Essentially, it's a process we use to determine the fair value of a company's shares. This is important for a variety of reasons, whether you're analyzing an investment, considering a merger or acquisition, preparing financial reports, or even dealing with legal matters. Knowing the true value of shares helps stakeholders make informed decisions and ensures transparency in financial dealings. Next, let's look at the methods used to estimate this value. There are primarily three main approaches. The first is the net asset method, also known by several other names like the intrinsic value method, asset backing method, or simply the asset basis method. This approach focuses on the company's tangible assets and net worth. The second is the yield method, which considers the income generated by the shares, such as dividends or earnings, relative to a required return or yield. The third is the fair value or average value method, which often involves market-based comparisons or averaging techniques to arrive at a fair estimate. Now, diving a bit deeper into the first method, the net asset method. This approach calculates the value of shares based on the company's net assets, which is essentially the total assets minus total liabilities. It's particularly useful for companies that have significant tangible assets like property, plant, or equipment. To find the value per share, we take the net asset value, or NAV, which is simply total assets minus liabilities, and divide that by the number of shares outstanding. This gives us a clear, tangible measure of what each share is worth based on the company's assets. Moving on to the yield method, this technique is all about the income that shares generate. It's especially relevant for companies where dividends or earnings are stable and predictable. The idea here is to value a share based on the income it produces, relative to what investors expect as a return. So, if a company pays consistent dividends, we can use this method to determine what those dividends are worth in relation to the return investors seek. It's a practical way to value shares based on their income-generating potential, rather than just assets or market prices. In summary, each of these methods offers a different perspective, whether focusing on assets, income, or market perceptions, and choosing the right one depends on the company's nature and the purpose of valuation. Understanding these methods helps us see the bigger picture of how share values are determined in the financial world. Now, let's look at what the Companies Act of 2013 really is. Essentially, it's a comprehensive law in India that governs how companies are formed, how they operate, and even how they are dissolved. It replaced the older Companies Act of 1956, and the main idea behind this update was to modernize corporate governance practices. It aims to promote transparency, ensuring that companies operate openly and honestly, and to strengthen accountability so companies are answerable to their stakeholders. This act is a cornerstone for creating a more efficient and trustworthy corporate environment in India. Moving on, you might wonder, how many sections does this act contain? Well, it's quite detailed. It has a total of 470 sections. That's a lot of provisions and rules designed to cover every aspect of corporate functioning comprehensively. Finally, what is the main objective of the Companies Act in India? The key goal here is to modernize and streamline corporate regulations. By doing so, it makes it easier for companies to comply with legal requirements, encourages good governance, and ultimately fosters a more robust and transparent business environment. All of these efforts tie into the broader theme of creating a resilient, transparent, and accountable corporate sector in India. Now, let's take a look at the minimum and maximum membership requirements for different types of companies. For a private company, the minimum number of members required is 2. That means you only need 2 people to get started, making it quite flexible for small businesses or family-run ventures. On the other hand, a private company can have up to a maximum of 200 members. This range allows for some growth while still maintaining a relatively close-knit structure. Moving on to public companies, the key point is that there's no limit to the maximum number of members. Public companies can have thousands, even millions of shareholders, which is essential for raising capital from the public and supporting large-scale business operations. Now, let's talk about the one-person company, or OPC. As the name suggests, it's a company owned and managed by just one individual. The idea behind OPC is to make entrepreneurship easier and more accessible. It simplifies the process of starting a business by allowing a single person to operate as a separate legal entity. This concept promotes entrepreneurship in India by reducing the barriers to entry, encouraging more individuals to start their own ventures without the need for a large team or multiple shareholders. So overall, These different company structures and their membership rules are designed to cater to various business needs, from small startups to large corporations, helping foster a vibrant entrepreneurial ecosystem. Now, let's talk about what accounting standards actually are in India. Essentially, they are a comprehensive set of rules and guidelines that determine how financial transactions should be recorded, measured, presented, and disclosed in financial statements. These standards ensure consistency, transparency, and comparability across different organizations, which is crucial for stakeholders like investors, regulators, and the public to trust and understand financial information. Moving on, you might wonder who is responsible for issuing these standards in India. The answer is the Institute of Chartered Accountants of India, commonly known as ICAI. They are the authoritative body that formulates and issues these standards to maintain uniformity in financial reporting across the country. And just to clarify the abbreviation, ICAI stands for the Institute of Chartered Accountants of India. It's a professional body that plays a vital role in regulating the accounting profession, setting standards, and ensuring that chartered accountants uphold the highest levels of integrity and professionalism. So, in summary, accounting standards in India are essential guidelines created by ICAI to ensure that financial reporting is accurate and consistent, which ultimately builds trust in the financial information companies provide. This ties back to our overall theme of understanding the framework that underpins financial transparency and accountability in the Indian context.